Hi, and welcome to the Aero Asset Heli Market Trends Live. I'm not from Heli Asset, I'm Alistair White from Helicopter Investor, and I'm delighted to welcome you to this roundtable focusing on helicopter finance and leasing. So thanks very much to Aero Asset for that. And I'm going to hand over to our first moderator now, who needs no introduction. Ed Washeka has been leading the helicopter market for more than 25 years. He was CEO of Aero Helicopters as an operator, then Waypoint Leasing. Ed, how are you?
Good, thank you. Nice to see you again.
Nice to see you. We've got matching paint as well.
So yes, true, yeah.
So, Ed, how are you seeing the market at the moment?
It's certainly better than when I left it. It's like, interesting times when all the sort of order announcements. It sort of brings back memories.
And also rumors of some M&A or something.
Yeah, interesting. Certainly. We'll talk about that in our session next. I don't know if Trey will have a lot to say, but certainly the rumored price for the Macquarie book certainly seems pretty healthy.
Right, and on that, I'm going to let you take over with your panel. So I'm going to hand over and let you introduce your panel.
Thank you. Hi, everybody. Thanks for joining us. I'd like to introduce our panelists before we get going. Sebastien Moulin with Milestone, Trey Wade with Macquarie Rotorcraft, Nigel Leishman with LCI, and Michael York with GDHF. Welcome, guys. Thank you.
Hi, Ed. How are you?
Good. How are you guys doing?
Hi,
thanks, Ed. Good to see you all.
Good. Okay, so look, we'll get right into it with some of our topics. And for folks in the audience, if you have questions, you can sort of feed them in on your application, and they will get routed into me, and maybe we'll talk about some of them. So with that, I'd like to start with the order books, which we have seen a lot of announcements from some of you guys as well as from others in the industry over the last couple of years, and there's no question that the market's gotten a lot better since when Waypoint fell apart. But one of the things that I remember really well and being really stressed about was, and I don't remember the precise timing, but it was basically right before Milestone announced its sale to GE, and we were trying to place a 225 at Waypoint. And we were negotiating with Babcock, and basically the price just kept coming down because we saw it as it's going to be hard to place these aircraft. We were competing against Milestone, and it was kind of like a reverse auction without being a reverse auction, and the pricing just kept getting better and better. And at one point, we just sort of walked away with it, so we couldn't see the logic in it. But of course, from Milestone's perspective, they were trying to get their deal done with GE. They probably didn't want to have an AOG, and so it was very sensible for them to be trying to place that aircraft. And in hindsight, probably still looked like a great lease rate given what happened to the 225 market. So I just remember being very stressed about these order books and how we're going to sort of place these aircraft. And when I see, Michael, you've got, a healthy order book that's announced. The other three guys on my screen don't necessarily have much in the way of order book but they do have a large installed base and probably feel it's a little bit easier to manage. And then there's also order book out there with operators and other sort of lessors not on this list. I guess I'd like to ask you guys, is this a concern for you? Do you feel we're destined to repeat the mistakes of the past? Don't all speak at once.
Listen, I want to start.
Yeah, I'm happy to start because, like Michael, LCI, we do have an order book. We ordered together with our partner SFML earlier this year. We did put a modest order in with both Leonardo and Airbus, and that came about after quite a long time of evaluating and looking at the market and trying to understand the market dynamics. And, I think we all agree that at the moment, supply is limited into many of the markets that we're active in. And lead times for new deliveries are now exceed 24 months, even longer in some cases. And we're also competing with the OEMs who are selling to kind of government and military customers. And all that kind of adds up to a situation whereby we know that many of our operators and end users are not very good at planning ahead. And I think somebody needs to be able to basically be able to provide helicopters in the near term. And I think that's probably what's driving both myself as well as Michael at GDHF to take a kind of modest position in the speculative orders. So I think it's different to the first time around. I was around like you, Ed, for that. It was a very interesting journey. But I think we've learned our lessons. And as I said, it's more about just making sure that there's some discipline out there across all the parties, including the lessors, but perhaps more importantly, the OEMs as well.
Can I, before anyone else jumps, can I ask, so do you guys see the OEMs exercising more discipline in this cycle than perhaps the last?
Yeah, it's mixed at the moment. I think they would like to. There's always a temptation to sell more helicopters. I think there's obviously that pressure from shareholders. We want to make sure that, and there will be other lessors who are probably interested in buy helicopters. Many of my colleagues here will do that. We want to make sure that they are selling to proper lessors, because when they sell to a lessor, ultimately we have to find customers for these helicopters. What we're concerned about, and to some extent, is other parties coming in, ordering helicopters, either firm or options, and then deciding later on to either lease or sell those helicopters back into the market. That's the point where OEMs start to lose control, and I think that's where we need to see some discipline.
Sebastien, yeah.
If I can comment, look, and I will echo some of the comments from Nigel, obviously. Look, I would say like the first good news is like most of us have been through the worst, of the oil and gas segment in particular, right? So I think we are all in this business in 2015, 2016, and the years afterwards, where we had too many orders and too many aircraft on the ground. So I think keeping a modest order book across the industry is probably key, and the discipline word that Nigel has used is obviously very very important, just to protect ourselves, right? And not only us, but also the operators and everyone in the supply chain. The reality is, like, I'm not as convinced that the OEM are disciplined and that all of us will be that disciplined. So if you look at the number of super medium orders right now, you're already over 100 if you include the options and the firm options, right? So and the firm aircraft, sorry. So that's the key to me. Is like, at the end of the day, if you look at the oil and gas segment, which is where a lot of the money is needed, a lot of the lessors will be involved in this, and those new orders will be going into the same segment. The challenge is, like, that market is a given market, right? So you have 300 aircraft today flying across the heavy and the super medium. And yes, there is a transition that is needed for new technology. Yes, a number of 92s in particular will be coming to the 20 years mark, but that's going to be progressive over the next decade, right? So and if we all bring in a lot of super medium at the same time, well, we may end up in a difficult positions. And if you look at the end users have placed the orders, the major operators have placed their orders. So, PHI, Bristow. So at the end of the day, lessors are not demand, right? As I'm sure you will all agree. It's just like, we are here to provide the aircraft that the market needs. But if they don't need those aircraft, and if they have already placed the orders, we'll end up with, no solutions. And because an aircraft place is better than an aircraft on the ground, you end up going down to the wrong spiral, as you described, Ed, where the pricing becomes a bit irrelevant and not exactly attractive. So I think those are the key aspects we all need to monitor. And yes, you can have orders, and we still have actually a small order book on the medium side, but this is something that we are a little bit skeptical right now on the super medium side.
Michael, would you like to comment? Because you're probably in this group with the largest announced group of orders compared to like installed fleet.
Yeah, absolutely. And I welcome my professional colleagues, Trey and Sebastien and Nigel and you, Ed, there. And yes, everyone has a different perspective coming into this market, observing this market, and we all do bear the trauma of 14, 15, 16, 17, probably the most Ed. And we see it as a different situation now, having lived through the down cycle, the flat period, and the up cycle with the excursions in between. What we had in 12, 13, 14 was an oversupplied market with a lot of froth and bubble. We had actually significant excess aircraft with growth expectations and orders from lots of people, lessors, multiple lessors, and operators. I see a different market now. We had a sustained period of very, very few deliveries into the space. And I'll start talking about the long range space, heavy and super medium. Really, we had single digit deliveries for 5 or 6 years into that space. Very little S92s, onesie twosies, small numbers of super mediums. So we get to the situation we have today, which is a very finely balanced market, very tight. Lessor fleets are utilised, operator fleets are fully utilised. And we have an environment where that's reflected in end user pricing for our customers, the lessee operators, which in some cases have doubled in the last 24, 36 months, which is very welcoming for the industry because now we're seeing a healthy, sustainable price being paid for helicopter services that washes through the MROs, the financiers, all the way back to the OEM. What we also have is a replacement need coming, and both Nigel and Sebastien referred to this. If you think about the offshore fleet, 270, 300, long-range super medium fleet, about 190, 193 S92s, about 80 super mediums, pretty evenly split between 40 H175, 40 AW189s. That's a very established situation for the super mediums. We feel that the ecosystem is solid, but we do know in the next 10 years, those S92s are going to retire if we take the thesis of 20 years. And that's pretty mechanical. And that will happen. And that's the zero growth thesis of GDHF is based around this mechanical aging out reality and the need for metal. Nigel spoke about it. Someone's got to supply the market. We've seen some operators order, the ones with older S92s in their fleet, super mediums I'm talking about, and we've seen some end users in relatively small numbers order as well. The GDHF investment philosophy is, well, we see the market need. We don't create demand. The end users do. We see the installed base. We're expecting zero growth in that base. We see that at least being static, maybe some small growth. So our super medium orders of 30 over the next 5, 6, 7 years is pretty small amount of that replacement demand. We're not going to meet all the demand for that metal. We're going to meet some. We think it's a very sensible investment thesis. We know about the lead times. So that's on the super medium's place. In regard to the supply story, we don't see a tsunami of demand coming on. They're sold out for the next 2 or 3 years, the OEMs. They've heavily prioritized military production, which is sensible. And we don't think their ramp-up plans are really, their aggressive ramp-up plans are achievable in the current supply chain environment. That's where we may differ from the OEMs, but we think if, there's pretty high numbers being spoke about in 29, 30, let's see if they achieve that or not. I don't think so. But certainly the numbers of super mediums going to oil and gas over the next 5 years is pretty modest and pretty sustainable given the drawdown rates of the S92. That's my view on the super medium market.
I appreciate it. Thank you, Michael. And I'm going to move to the next topic just because I don't want to sort of monopolize the time. And we're going to start with Trey on the next topic. I do want to just I want to make one sort of snarky remark because, Nigel, you talked about non-serious lessors. And I think I've always considered myself a non-serious lessor, but I think everyone on this screen, if you think about like when you were sort of starting out, when the company was starting out, was a little bit of, was they a serious lessor? I mean, Macquarie certainly was a big aircraft lessor when they started, but, it's just sort of, you become serious when you start sort of placing these aircraft. And I know what you mean. I mean, the three of you were quite well established as the big three here. And Michael's group has raised some capital and is sort of starting, but it doesn't take much for someone who's put some speculative orders in and had a few things go right for them to become serious. So,
listen, sorry, Ed, it wasn't directed personally towards you. I think.
No, but I try to be. I'm making a joke. I do try to be non-serious. Obviously,
right. Listen, I think it's people think it's very easy to become a lessor. I think all of us on the screen realize the challenges we have. there's been a lot of people that perhaps accidentally have become lessors. But I think it goes back to my point about discipline in the market. And making sure, because as lessors, we ultimately have to find customers for these helicopters, and often these same customers, the OEMs are talking to directly. We're in a situation where often we're competing with the OEMs, and that's not a healthy situation to be in.
And that is our next topic. So Trey, I'm going to start with you, because we do, there is the Equinor interest in buying their own aircraft, leasing them out. One of the things that was very clear with the pain that the customer base experienced in oil and gas was the tendency of these contracts to have very end user friendly provisions, which the operators were willing to take that risk. The lessors may have been more disciplined and looking for a fixed term, non-cancelable, but and if too many of those operators have allowed for that kind of mismatch, as we saw with CHC, bankruptcy puts a lot of those aircraft back. So I guess the question generally, but have those oil and gas provisions that were so difficult for operators, have they changed? Have operators gotten more religion about how they're going to manage their exposure to their end users? And how are you guys all dealing with that?
Yeah, it's a good question, Ed, and it really underlines the fundamentals that make all of our business successful. We're starting to see, not starting to see, we are seeing pockets where it has improved. As you mentioned Equinor, obviously they're making a real commitment. Petrobras has obviously been sucking up a lot of demand, and those contracts are really rock solid, non-cancelable, without cause. You're seeing a couple of other of the more international oil companies being more thoughtful, planning ahead in advance, and not having these punitive termination for convenience clauses and other things that have been plaguing us for such a long time. But on the flip side, we saw a contract come out not long ago that had a 7-day cancellation for convenience option. So really it comes down to our shareholders are not going to underwrite something like that. We're happy if the operator is going to take the risk, but fortunately in this market we're seeing more discipline from the operators. I know that pretty much everyone no bid that contract, or they submitted a non-conforming bid because they just wouldn't accept it. So I am pleased that not only the oil companies but the operators are they learned their lessons too. And obviously all of us have learned some very painful lessons. So things are getting better. We're still not there yet, but I think the progress is encouraging.
If I could jump in there, Trey, I think, the operators are being disciplined, but I think we as lessors are also being more disciplined. I think we're talking to those operators and we're sending the same message in many cases, which is that we don't want to be doing leases which have that sort of terms underlying it. So a risk, it makes it difficult for our shareholders. It also makes it very difficult for financiers as well to support this industry going forward. And we listen to people like the IOGP who are making statements around contracting discipline, or contracting principles and things like that. But the words are not really being turned into action. Certainly, they often, when it gets down to business units, they're still trying to impose some of these punitive terms, which, to be honest, are just not really sustainable in this industry.
And if I can add something, I'll be honestly curious to see if the oil companies, even the one that have placed the orders, will repeat the same orders in the future. I think they are going through right now some through tough negotiations and realizing how much the operators and the lessors have been delivering a lot of value to them. Just the risk that you take on when you place an order directly. The risk that you have with the residual value of the asset, the risk you have with the spec of the aircraft, the change of configurations, monitoring the delivery and everything else. We can see that, in all those discussions where they're trying to get financing for the aircraft and get some operating lease in place, clearly there is a learning curve, and it probably, for some of them, is a steep learning curve. And at the end of the day, are they going to pay less for the service? I'm not convinced. And I think so long as we stay disciplined as across the leasing side, across the lessors and the operators, I think we'll get to they'll get to the same positions with probably less flexibility on their end.
Yeah, good comment, Sebastien, and I would agree with you that leasing looks easy from the outside. All companies fancy themselves as lessors. Their lived experience is probably not so happy. So let's be glad that they did this. They might have more respect for our role in the value chain. I think they will now. But look, oil and gas and the helicopter services industry associated with the is a cyclical industry. Right now, we're established an uptrend, and we see better behaviour. As one operator told me, when the oil and gas company starts talking partnership, you know that helicopters are tight, right? So, so we're in the stage of the industry, and as lessors, we need to lead, and our operators, some of them have been very courageous in leading. No T4C is to better terms and conditions throughout the industry. And obviously, when you're financier backed, like LCI and GDHF, we have to. It's mandatory. So we need to not be involved in transactions like that with 7-day termination of convenience. But in general, the better behaviour from the oil and gas companies, the better terms and conditions, and doubling of end user rates in some cases reflect the very tight helicopter market that we have, and the limited supply coming on, and the increase in kind of oil company appetite for modern equipment, new technology. And to be fair to them, they have engaged more, the end users. They are doing better terms and conditions in some cases. And certainly the contract lengths we're seeing are longer.
Yeah, so let's switch a little bit to, on the financier back. So I'm curious how you guys are all finding cost of debt with respect to oil and gas, or availability with respect to oil and gas. And yeah, while two of you may be financier backed, the other two sort of funded by parent company balance sheet, I'm sure you guys are all talking to banks at different levels. And one of the questions I had, sort of the availability question, but also does the availability or lack thereof, does it help Milestone and Macquarie? Like, do you guys sort of find it, are you comfortable with the debt availability? Because at the end, if it's harder for LCI and GDHF, it's more expensive for them, and that makes it a little bit more profitable for you.
Look, I would say from our side, surely we are lucky enough to be backed by AerCap, yes, with an incredible amount of debt that is being raised, every year, and that's unsecured debt that support the growth for Milestone. And I think this year we will have committed over 300 million of new capital to go into the space, right? So there is no question that there is a real benefit. But at the same time, what is key for us at this stage is like portfolio management. We're not going to be growing for the sake of growing. I think clearly, with the 3.5 close to $4 billion portfolio, we just we want to keep it healthy, and the best way to do that is to be able to trade aircraft via portfolio management, via portfolio sales, and we've explored a number of transactions with some of the colleagues here, and we've done a transaction last year with Macquarie, and we'd love to do some more. So we've been talking to banks regularly via our team, via the treasury team at AerCap. We have a lot of strong relationship with those banks. We obviously keep a strong relationship with the appraisers as well. So I think what we want is everyone to get access to those funding options, and so we can have an healthy business environment. So long as the discipline is maintained, I think that would be a way forward.
Yeah, I would echo those comments. As LCI, we've been reliant on bank debt for the last decade. We were out there talking to banks and raising debt for helicopter transactions since 2013. And it's not been easy, let's face it. We've gone through some very difficult times. We've gone through some very well-publicized bankruptcies, and that's put a lot of the banks off this particular sector. But we have to understand it's not just oil and gas, it's right across the industry. And, for us, oil and gas is a fairly small part of our portfolio. And it's roughly about 30%. The rest of it is more on the EMS side. And there's a lot more options when it comes to the financiers out there. And if we're talking specifically about oil and gas going forward, there are financiers out there that will do this, sometimes at a premium. But there are an increasing number who are, very environmental or ESG conscious about it, and that's a challenge for all of us. I think at the end of the day, we work closely with our Japanese partner and shareholder and SFML and trying to tap new sources of financing in here. But I think overall we should be doing what we can to just highlight the importance of the helicopter market right across the various missions out there. This is a really mission critical service, and hopefully we can get the financiers and other investors to support that.
Michael, you want to comment? Because you just had your debt announced financing.
Yeah, this week, and it's interesting. And yet, Nigel, I appreciate your struggle now a lot more than I did maybe 8 months ago. And look, yeah, we all have unique challenges, the four of us leading organisations. But certainly we've been encouraged. I know that's an interesting word to say, but look, bankers are rational. Where they see an industry sector, transportation, subsector aviation, subsector helicopters, where the returns are becoming attractive, the kind of the disaster of 10 years ago is really 10 years ago, and they see a sustained uptrend. We actually were very encouraged by the two banks based in London and Frankfurt, respectively, that backed us to the tune of 77 million euro, had never financed helicopters before. It's very interesting. So we kind of started with a greenfield conversation and a lot of education about the industry and the importance. And honestly, they were amazed by the returns in the helicopter sector compared to the commoditization of commercial aviation. When you think about lease rates down at 0.65 in commercial aviation, up 1 and above in helicopters, where you've got mission critical sectors and long contracts now, 10-year leases and so forth, is quite attractive for them. Now, that's not an easy sell, and there's not an enormous number. Probably another trend, but we did it, right? And I think we'll do more because the numbers speak for themselves. And if you've got an investment thesis that we think is strong, that also sells as well. I'd also add that perhaps we've past peak ESG. We look at the actions of BP, Shell, Equinor, drawing back from wind investment. BP in particular have been very vocal about changing strategy and investing more in oil and gas where the shareholder returns are. So banks are also aware of margin and shareholder return.
Yeah, we are definitely past peak ESG in the United States with the new president coming in. Anyway, so let's move to our last topic, because I'm cognizant there are folks waiting to kind of come on and speak after us. But I want to talk a little bit about the heavy helicopter market. So, with Milestone, I've got a lot of 225s, a lot of S92s. Macquarie has a pretty, I think, healthy amount of S92s. How do you guys, and this is sort of for anyone, but the 525 is sort of coming along. So how do you guys think about this market? Where would you put your money in this sector?
I think we put a lot of money already in this sector.
Yeah.
But look, there are two aspects, right? The 225, no questions. We've been, working very hard on repurposing that aircraft, redeploying those assets, and now recently we've been selling a lot of those assets. We've seen, interest growing into the market for utility, for power, public operations. We've signed a strong partnership with Rototrade, which has been a successful story for us. Selling down a number of those assets that then they have flipped into different market where we frankly had no access to. So I think that's one aspect. We see it a little bit differently. We've also seen some demand coming back on the oil and gas side. Probably, look, I've seen a lot of the comments. Obviously, probably never in the North Sea. We're conscious of this, and I don't think we're spending any time marketing the 225 into the North Sea. But you would have seen recently, in regions like Namibia, where you have explorations that are far enough, where there is, LIMSAR requirements that are also far from the coast. The 225 is an asset that is fulfilling that mission. The oil companies are, also conscious that they can get access to those probably a little bit cheaper than the 92. So that's sort of the trend we've seen on the 225 front. For the 92 is a little bit different. It's it's been very robust over the last 3 years. We've we put back those older 92 into service. They're all flying right now. The 92 across the fleet globally is like, close to 2 million flight hours per year, right? So it is flying a lot at the minute. There are obviously like supply chain constraints. We hear a lot about this. To be fair with Sikorsky, that's also like comments we get on the Leonardo and Airbus side. They are just better at focusing on the new product and not speaking about the supply chain issues. And it's probably also because the S92 is still doing the most number of flight hours, right, across the oil and gas segment. But there is no question there is a transition that needs to be prepared. There is a number of assets that will be coming off lease, that will be coming to the 20 years mark. Some of them coming up to the 30,000 hours limit as well. That exists with Sikorsky. So we've been working on secondary missions. We developed and certified this year the fire tank for the 92. Is that going to be a big market? Probably not, but certainly like a niche market where the 92 can deliver some value. VIH has been operating last summer and is intending to operate it in the US as well next summer. So we'll be certainly pushing for this. We've financed a number of part-out aircraft. So look, it's all about portfolio management. As I said, we'll continue investing in new assets and making sure we deliver the best value for the 92 and the 225 over the next decade. That's our job.
And so, what about the for someone? Any other comment or about the 525?
Trey.
Trey.
I'll admittedly be a little bit biased. I was at Bell when they launched the program. Seems like 50 years ago. And we were all privileged just to go down to Bell recently. They hosted us for a lessor day, and I can tell you, it's an extraordinarily impressive aircraft. Maybe just the smartest aircraft out there, and it's got some stuff that no other super medium or even 92 can do. So it is a really impressive machine. That said, the economics are difficult. Obviously the market is adjusting itself, as Sebastien mentioned, with the 92s are going to be phasing out over time. There's going to be a natural transition to super mediums. I think the 525 can do some stuff that the 175 and the 189 cannot do, but the economics are just really they're just not there yet, and we want to wait until we see the market kind of materialize. If you had 525 sitting on the ramp right now, I'm not sure you could get an operator to take them. It's just because transitioning and introducing a new type is difficult. It's expensive. There's a lot of risk involved, and you need a really detailed cooperation with the OEM and everyone up and down the supply chain. And we're starting to see some movement from Bell in that direction to kind of support the launch of the program. And I think they'll, like Bell, they'll always be there to support the aircraft once it's fielded. But getting it fielded is their focus now, understandably. And I think we're all just kind of waiting to see.
Thanks, Trey. All right, so maybe one. Oh, sorry. Do you want to say something, Nigel, on that? Yeah.
No, listen, I was just going to echo what Trey said. We follow that program with interest. We kind of largely sat out the heavy market. We have very few S92s. We've kind of focused on that medium and to some extent the super medium market in there. But the 525 is obviously that next development. But at the end of the day, like any lessor, we're looking at helicopter types that have large operating bases, multi-mission, proven markets. So it's going to be very hard to go to our investment committees or our shareholders to look at some of these helicopters, which at the moment are very early in the development phase. And at the moment, I think with the Bell 525, we haven't even got an announced customer yet. So we'll watch with interest to how that's going to develop.
Yeah. All right. Well, so look, one last thing. I said this was the last thing, but one last thing, sort of yes, no. So are any of you guys, or how much are you guys thinking about tariffs? Is it relevant? Because Trump talks about it. If he launches tariffs, there's a possibility of other countries retaliating. Is that something you have to think about?
Not specifically. Look, in general, it's an uncertain world at the moment. The rules-based economic order that we've had for 40, 50 years may be breaking down. We know that open global trade without barriers drives wealth creation and better standards of living. When you put tariffs and trade barriers in there, that obstructs that. As a general comment, in terms of additional tariffs, additional cost, eventually that'll have to be passed on to the customer in one way or form.
Yep. Anyone else?
Yeah, again, at the end of the day, sorry, Sebastien, we're just looking at macroeconomics. There's other things going on there as well. I'm more interested probably directly about interest rates and what's going to happen there. That passes straight throughs into rentals and costs for everybody. And so, yeah, we live in uncertain times, as Michael said.
Yeah, and look, I'll just echo this, and obviously, like, China in particular, and the relationship between the US and China is one that will be looking at with interest too. For AerCap, that there is a large exposure in China. It's a big market for us too. So we just, we need to see and understand what will happen next. So
okay,
that's.
Thank you. And actually, I keep extending. I'm not trying to extend this. So for the folks who come next, like it's not my fault. But a question from the audience. So with almost 25% of the oil and gas fleet now managed by lessors, compared to around 10% 10 years ago, how is that likely to affect the market?
Well, if you look at the commercial aviation space, we're actually on the journey to the penetration that is in commercial aviation. You could say that there's more growth to go in that space. It's more efficient use of capital. Probably it sits on the right balance sheet when the lessors have it. So I think we already have an example in the commercial aircraft market.
Yeah, I mean, frankly, on the oil and gas side, I think that there's no questions. The operators see the benefit of the operating lease, and even the end users are seeing it now. So, I think, look, wherever there is a need for new investments, and if that makes sense, operating lease will probably be a good solution.
Yeah, I agree.
Yeah, and ultimately, this industry needs the capital. And I think we as lessors are probably, it goes back to my original statement at the start, we're going to be more disciplined than perhaps the operators have been before. So on the oil and gas thing, I think that's a positive.
Yeah. All right. Well, look, I'm going to have to run because I have to go raise that $1.2 billion to buy Trey's portfolio. So it was really, really nice to see you guys all here and to do this panel. Al, back to you.
Thank you, gentlemen.
Thanks, everyone.
Thanks, Ed, and thanks to everyone. That was a great session. I wasn't sure about the serious non-seriousness we got in at the start. I'm now handing back to Ed Sale, who of course is hosting this. Ed is with Aero Asset. He's been selling helicopters for almost 25 years. Started at Sloan Helicopters, then Airbus. Sloan obviously is the UK Leonardo distributor. Ed, how are you? How's the market?
I am very well, Al. Thank you very much. It's been a good year. Been a great year for Aero Asset, and it's not over yet. We've still got where are we? 2-3 weeks to go. Still got a couple of closings that are on the table. So it's that usual last minute. Forget about Christmas. Just get the deals done. So yeah, all good. Thanks very much.
So it's a shame you're going to have your Christmas ruined, but I'm sure it's worth it. I'll hand over to you now.
Great. Thanks very much. So I am very pleased to introduce Steve Nixon, who is Head of Asset Management and Trading at ITC-AeroLeasing. We've got Chris Lloyd, Managing Partner at Aerius Group, PTE, and Richard Liao, who's the Senior Vice President, Head of Structured Finance Department from Chailease Finance Company. Gentlemen, thank you very much for joining us and staying up late, because you're certainly hours and hours ahead of me in the UK, where it's just a nice kind of mid-afternoon time. Great session from Ed before, and I think just to briefly get into the session and follow on from Ed's session, there was an awful lot of focus on the oil and gas industry and that market. Obviously, there are other markets that lessors are involved in, but what's your main focus, Steve? It's why don't we start with?
Yeah, sure. Hello, can you hear me? Okay.
All good. Thank you very much.
Good. Well, good evening from Tokyo. So our fleet right now is comprised of about 75 aircraft, both fixed and rotary wing. On the rotary side, primarily HEMS, combined with search and rescue, some utility, a few other mission types. We we are, as the guys mentioned in the oil and gas section, I didn't catch all of it, but I heard the word discipline and sustainability, which is true of our segment as well. There's obviously multiple players in all segments of helicopter leasing and financing now. I think it's grown significantly over the last few years again, with more new entrants. But yeah, things remain positive for us as long as we stick to our principles and remain disciplined. And we've been in business now for around 40 years. It'll be our 40-year anniversary next year. So yeah.
Interesting. And Chris, you've obviously been in this world for a long time, huge amount of experience, but the company is relatively new in the grand scheme of things. Are you focusing on particular markets as you get the company going?
Yeah, hi Ed. Yeah, first of all, Ed and Emmanuel, thanks very much for inviting us onto this very esteemed panel of speakers. Absolutely, we're the new kids on the block. Aerius has only recently launched, and we do see ourselves sort of, you know, in the area, I guess, which is underserved, I suppose, certainly on the leasing side. There's obviously a lot of talk in the previous panel about the oil and gas space, where obviously, you know, they are sort of fairly focused, although as Nigel did point out, certainly on other markets as well. But Aerius really is focusing on, I suppose we would call it, I guess, sort of around the sort of sub $10 million level, which is single engine helicopters, maybe the light twins, which we don't really see the other, at least the larger lessors really playing in for the moment. And certainly that area is underserved in certain, you know, geographical parts of the world. So we talk about Asia Pacific in general, you know, Middle East, Africa. There's really not that many people that are playing in that, you know, part of the market. So we certainly want to focus on that. We're also focusing on the fixed wing side. Maybe that's a topic for another roundtable, but certainly the turboprops, you know, King Airs, Caravans, that sort of thing. And again, you know, these assets, we believe, have very solid residuals, which is what, after all, any lessor is interested in. Clearly, that's why the asset types that the people on the previous panel have chosen. But it's, you know, because of that reason, we feel that, that there's a very strong demand for that sort of leasing product, and it is underserved, you know, at the moment. So really, that's what we're looking at. But in addition to that, we're also looking at financing. And so that's something which is possibly other lessors are not really doing so much. It's financing of assets across the board, and that would be all the way from sort of the larger corporate jets down to single engine helicopters. So it's both financing and leasing that we will be, you know, the area we'll be playing in. And because we'll be looking at the single engine helicopters, the lighter twins, we believe we can work with brokers such as yourselves, Ed, assisting you guys to move some of your products. So we very much look at ourselves as working, you know, across the whole industry. Having said that, we're not really in the sort of the mediums and super mediums. Again, if our customers specifically want us to look at that, we will. But we do see that area as being quite well served already. And so really we're looking at the other areas that, as I said, I believe are slightly more underserved right now.
Interesting. And Richard, so with that that sort of thought following on from Chris, it's a case of do you have a minimum amount that you would lease?
I'm very interested about the Chris. You say you focus on Asia Pacific and Middle East, which Chailease also cover. We cover Asia Pacific region. We cover Middle East, and we also cover some part of Mediterranean. And Chailease, we only focus on on the VIP part. So for the helicopter, we provide finance lease for VIP for single engine or for some twin engine like H145 or AW139. So that's pretty similar for our business area. And we also focus on business jet and super yacht as well. So it looks like three different industry, but we share the same customer base. So normally the customer, the UBO, they when they acquire their private jet, and then next there will be super yacht, and then the next there will be VIP helicopters. So that's the industry we finance. We focus on those ultra high net worth customer, and we don't take residual value risk. So we only do finance lease.
Yeah. Okay, so it's coming from some of my background, where Al said very kindly that I've been in sales for 25 or so years. An awful lot of it has been, but I've also been an owner operator in the UK, but always very small numbers and on the charter side of the industry. But the companies I've been with, we never considered leasing. It was always a case of taking debt and essentially going to the OEM, purchasing our aircraft for the requirements that we had. So why, in your experience, would an operator take a lease over debt?
Well, for the operators, sometimes they have no choice, especially for the light helicopters. Unlike offshore oil and gas or offshore wind farm operators, Milestone, LCI, they might provide operating lease for them. But for the smaller operators, like in Asia Pacific region, the operators, they tend to operate H125, H130. They don't have a strong balance sheet to support the debt. So the only choice is finance lease. So for finance lessor like Chailease, we tend to provide finance lease. That's the purpose for if any event of default happen, to be a lessor would be easier for us to repossess the asset.
Okay, and Steve, have you got a view on operators taking leases versus debt?
Similar reasons to Richard mentioned. You know, our product is quite similar. I mean, we don't do super yachts, but for the most part, we're doing finance leases as well. We do some pure operating leases long term, but for the most part, finance lease type product. Some of the operators that we work with have a mixture of debt and financing leases. You know, sometimes they've perhaps extended their credit with a particular bank or financier, and they need alternative options. So, you know, and some operators, you know, they've got different types of contracts where they perhaps prefer ownership of the aircraft themselves. Some of them, they may prefer a finance lease, which perhaps gives some kind of middle ground. And some of them, they prefer an operating lease, especially those kind of long-term or mid to short-term contracts, underlying operating contracts, where there's a high probability that they need to return the aircraft to the lessor. So, you know, operators need, especially larger ones, they need access to multiple options or financing solutions.
Yeah, Ed, I would agree with those comments for sure. I think a healthy mix of both debt, in finance lease and indeed operating leases is a good mix for an operator. And to your original question as to why would they look at an operating lease? I mean, quite simply, obviously they don't have to put a down payment down. Their credit could be maxed out, with their existing debt lenders for the fleet they've already got. And it allows them to match the lease to a contract that they've got and not have to worry about the residual value at the end of it, which is not really where these smaller operators specialize in. So there could be a number of reasons why they would want to look at an operating lease and to mix the supply of their assets to an optimal way that works for them. I think if an operator was just fully whole fleet was on an operating lease, it's a slightly risky situation. At the same time, if everything was on their own debt, debt funded, that is also a risky situation if the market was to turn, for example. So I think a healthy mix is probably the optimal position for operators, whether they're the largest operators or even going down to the smaller operators as well.
Okay, so going on from that, from a lessor point of view, when you're structuring a lease for an operator, what are you looking for from the transaction, and in terms of security in the background? They, particular types of contracts, particular types of assets. Is a reasonably standard format that you like to start at, and then you can manipulate it from there?
Well, if I continue on that, we are much more looking at the operator, and we're looking to put, bespoke solutions together specifically for the operator and the credit of that operator. And then for us, that is probably more important than the asset itself. And as I said earlier, we'd look at fixed wing, turboprop fixed wing as well as rotary wing. But what's more important is the operator. We usually would have a relationship with the operator, look at the past performance record, and we're trying to put something together which would work for them, because what we're interested in is the long-term growth of our customers, and that also helps us if they're successful. Hopefully they'll come back at least more from us in the future. So really flexibility is the key that we are looking to bring to this market. Flexibility in terms of the type of assets that we will look to lease, and working with customers worldwide. Although we're based in Singapore with an office in Dubai, we really are looking to service the market worldwide. And Richard, I know you picked up on what I said about servicing Asia Pacific, Middle East, and Africa very much as well. But we really see ourselves as servicing the market worldwide, wherever there is a need, and helping our customers get the sort of assets that they're looking for. So for us, flexibility and making tailor-made solutions that suit our customers' needs is what we're really looking to do.
What about Chailease, Richard? Because it's as you say, it's reasonably similar in terms of the private jets, yachts, and then helicopters. What are you looking for from the customer?
Well, if for VIP usage, the operator is only play the role of a management company to take care of the asset or operate helicopter for the ultra high net worth individual. So we will structure it as we look the credit status or the financial status of the ultra high net worth individual or his own company to provide corporate guarantee or personal guarantee in this transaction, and the operator only being a third-party management company to take care of the asset. So it's our typical structure.
Okay, and Steve, you've got some good fleet size going on. What's are you coming at it from a slightly different viewpoint when you're looking at what you're trying to achieve from a transaction?
No, the fundamentals are the asset. That both the aircraft type, the age, the operating jurisdiction, of course, the creditworthiness of the lessee, and how established they are, their track record, the underlying contracts which they're operating on. The criteria of our financiers and investors is very important. You can't continue in this business for 40 years again without being disciplined and ensuring that it's a sustainable deal for both the operator and for ourselves and for our financiers. So there's a number of key components that we assess when doing any deal.
Okay. And so you said the keyword jurisdiction. So Aero Asset is a global company, and we will operate globally. My little world has always been the UK, so I know the intricacies of the UK very well. But in terms of your companies, do you have specific jurisdictions that you try to avoid, and are there any particular reasons why you would avoid a certain jurisdiction?
I can start off with that. I mean, as far as we're concerned, no, we're not ruling out any particular jurisdictions, geographical jurisdictions. We're willing to consider pretty much across the board. Obviously, the trade sanction ones, of course, we're not talking about those sort of areas. But in general, we will consider the lease on its merits, on the merits of the operator, their creditworthiness, and we look at the whole situation. I mean, Steve mentioned that, and I know with the bigger lessors, they like to match the lease term with contracts, end user contracts. For us, that helps paint a picture, but that's not the only thing we look for. It is once again a bespoke solution based on the customer, our relationship with them, their record in the market. It is harder to do if it's a new entrant to the market. If you're a new operator with no credit history, that obviously is harder. You haven't got a relationship with them, so for sure that is going to be difficult for that operator coming into a market looking to avail of what all of us are offering. But in terms of, is there a jurisdiction we wouldn't touch? No, possibly some would have to be more careful in and than others, but we would consider them all on the strength of the operator themselves, and a lot of it is their past performance and how they have conducted themselves in the course of their business. Okay,
interesting. Richard.
We only do business with Captain Convention countries because they will be more regulated, and we don't do business in the region which we are not familiar with, like Africa or CIS region.
Okay, fair enough. Steve, have you seen any kind of recent significant changes within the leasing world, and has this opened up any opportunities for you?
Not particularly. Obviously, I'm aware of certain new entrants coming in. I mean, Chris himself has mentioned that his organisation is just starting in this space, although he's got experience in similar companies. Obviously the interest rates and the cost of capital over the last few years has hindered the growth and caused problems for some lessors, whilst it's perhaps presented some opportunities for others. In terms of sort of overall dynamics, it's probably been a positive thing for us and given us a kind of an edge that we've been able to kind of kick on and continue our growth this last few years.
Chris, Richard, have you got any? I mean, Chris, again, you've come at it from different companies and now starting your company. Have you sort of looked at any changes and taken those on board when so potentially changed your business model slightly when you've started?
In terms of the market we're servicing versus I guess where I was previously.
Yeah, exactly that. Exactly that.
Yeah, I mean, I really think, you know, as I said, response to a previous sort of a question, you know, Ed, we see ourselves in operating in quite a different market from I guess the big three now, big four lessors, which is mediums, super mediums, to some extent heavies. There's a big chunk of the market which they're not really servicing, and I don't really think that they're that interested to service, and that has led to an opportunity for us to evolve and really, you know, go into those areas. As there's really a lack of leasing options in large parts of the world. I mentioned, you know, Asia. It's interesting. Richard is Chailease is not really looking at Africa, but clearly Africa is a market that is prime for growth in if you want to have a, you know, wider phrase, general aviation, not just helicopters, fixed wing, obviously all the way up to commercial fixed wing. We're not looking at commercial fixed wing. I guess we're looking at general aviation, but certainly helicopters and fixed wing. We see tremendous growth in those areas. In terms of lead times, and one of the things that is slightly more flexible in the sort of market that we're looking at, areas of market we're looking at, is that the lead times of the mediums and super mediums is so long now. I think we're talking 24 months in some cases, more than that, up to sort of almost 36 months. It's an incredibly tight market, and it really is being catered for by the big lessors already, and of course some of the bigger operators are buying direct. That doesn't leave much left over. So if someone is, you know, out of the blue looking for a medium or a super medium right now, pretty much there's none around. They kind of have to go to the large lessors. The OEMs don't have anything available for them. You have to sort of wait 3 years. It's not the case in the market we're looking at, because the volume is so much higher. The number of H125s that are built, produced, and sold every year is far greater than obviously we're looking at the mediums and the super mediums, Bell 407s, and then of course pivoting across to the fixed wing, Cessna Caravans, for example. So the lead times are more manageable. There is more flex in that market, but at the same time, we believe there's very strong residuals. And those sort of products that I just mentioned, arguably on percentage terms, even stronger residuals than the mediums and super mediums. So really, that is the area that we're looking, and we see tremendous opportunity.
Yeah, it's I completely agree with you. I think it's a lot of my background has been on the single engine airframes, and I completely agree. I think the residuals are pretty strong on those machines. Which leads us nicely. I'm very conscious that it's very late where you gentlemen are, so I'll move on to the very final side, which leads us nicely on to actual asset disposal at the end of a lease. How does anyone deal with that? Richard.
Well, for the past 5 years, we have some repossession transaction. So for the helicopter, Aero asset help us to sell one of our H130, and yes, and for the corporate jet, it's a pretty standard sales procedure. So for the corporate jet side, I don't see any problem, but for the helicopter side, it will be more difficult to repossess and remarket in the market, especially it's not a very transparent market. Although we can repossess and put it in the market, but we still don't have enough assets to touch the end customers. So yes, I think Aerius can help us to do some remarket. Yeah,
always good to hear. Steve, what's your asset disposal strategy?
Well, I didn't mention our fleet composition at the beginning. I'm sorry, I gave a brief introduction, but essentially we've got a full range of Airbus models, everything from 225s right down to 125s, and everything in the middle. On the Bell side, we've got a few different models, 407s with we've had 109s, 119s on the helicopter side. I won't mention the fixed wing side, but I mean we're going everything from narrow body airliners to regional jets and regional turboprops, right down to smaller single engine commuter turboprops. So it's a very wide ranging, diverse fleet from many manufacturers. And in terms of when you talk about asset disposal of such a varied fleet, again, you have to be sensible in your decision making. We're fortunate that we have one business arm which does leasing and financing, and the other is trading and brokerage. So we're also active in the sale of aircraft and aircraft parts. So we tend to handle that internally, should we need to. We've got we're very established, fortunately, to have quite a wide-reaching network in both fixed and rotary world, through to operators, various different tier, different level operators that would perhaps be interested in some older assets if they come off lease, once they've gone through, they're getting to the latter part of their economic life. We also do some part outs, we do some part sales. So we've got a range of options that we're active in. Of course, we've got a long-standing relationship with yourselves, Ed, as well. I mean, I know personally we haven't worked together, but some of your other colleagues, Emmanuel and William, we've worked together in the past on some deals, some remarketing and so on. So
yeah,
some other
the best solution, if you've got one, as you say, is you're moving an older asset onto a new customer, and so you can maintain a lease of sorts and introduce potentially new business within the market, would be a kind of nice opportunity if it's available.
Yep, if it's available, that's obviously plan A, but you need a plan B and a plan C as well. So
absolutely.
Yeah,
Chris, I will let you have the final word from your side. When you are lucky enough to be disposing of assets.
That's right. When we get there, but actually, there's another part to your question, if I may, Ed, and that's the acquisition of assets. We talk about disposal of assets, and of course, I've had a long history in that with my company, a couple of companies back. That's what I did for many years. So we, and my sort of founding partner of Aerius is very experienced on the OEM side, on the new sales of assets. So we will. The plan is to sort of handle that in-house, but we'll certainly very much be planning to work with the brokers such as yourselves. And we see that very much on two sides: the disposal of the assets, yes, but also in the acquisition of assets. So if we have customers looking for a specific type, or the brokers have a type for sale, you find a customer that's looking for a lease solution, we'd love to work with you. So we see us actually working very closely with the brokers on both ends of the deal.
Fantastic. Well, great way to end, gentlemen. Thank you very, very much for staying up and imparting your time. And it was very very informative for myself, from coming at it from an operator point of view. And I will hand over to Al.
Thanks. Bye.
Thanks very much.
It's really impressive how late everyone stayed up for that panel, and great to see. We're now going to go to very cold Chicago with Russell Christopher of Thora Capital. Russell, everyone I'm introducing has got 25 years experience. Russell started in the fixed wing side on commercial aircraft leasing, moved into helicopters. How are you?
Very good, thank you. but definitely cold. It's yeah, I'm living in Florida now, so this has been a shock to the system to come back to the mothership.
I know, last time I saw it was lovely in Florida. Anyway, I'll hand over to you now.
Thank you, appreciate it. Hello, everyone. I'm going to be introducing 3 very esteemed panel members from the lending community. We have, more importantly, esteemed, but also active, because that's something that's in short supply these days. We have Andrew Blundell, Managing Director, Aviation and Marine Finance at Close Brothers. Hello, Andy.
Hello.
We have Christopher Lee, President, Aviation Finance at First Source Bank. And we have John Shaw, Vice President, Aviation Finance, Investec, Corporate and Institutional Banking. Hello, John.
Hi, Russ.
Hi.
Morning.
Welcome. So,
Thanks.
Yes, I mean, I personally, from my own experience, spend a lot of time trying to seek out debt financing for our transactions. And it's important for us to use leverage to reach our targeted return goals. I could speak for the rest of the lessors as well, I'm sure. I think it would be useful for the people who maybe don't know you so well, who are listening, for you to just each briefly describe your mandate as it pertains to the helicopter space, your deal profile, appetite, what kind of things you've been working on. I'll go in order of introduction, so I'll go to Andy first.
Thank you, and good afternoon, everybody. I hope you can hear me okay. So I head up the aviation and marine finance team at Close Brothers. Close Brothers is a fully listed regulated bank headquartered in London. The portfolio covers anything on the rotary side, from an R22 for an owner pilot or a flying school, all the way through pistons, single engine turbines, twins, HEMS, and offshore support. So all the way up to H175s and 189s. The portfolio has been running for about 45 years now. And we've consistently led throughout that period. Our primary focus is a fairly narrow geographic remit. So UK, Ireland, certain parts of Western Europe. I'm a lender, not a lessor, so it's pure bank debt, loan and mortgage. Very happy to finance private owners' businesses using aircraft commercially. We will also work with lessors to lend money into leasing structures as well. So we're happy to lend to a lessor, but I've got no desire to be one.
Thanks. Chris, what about you?
Yes, thank you, Russell. We have been financing helicopters for almost 40 years. We finance all major brands of helicopters from Robinson to Airbus, but we primarily deal with the major ones of Bell, Airbus, and Leonardo. Our deal size can, the R44s all the way up to the Airbus will range up to, 15 million and down, but our typical deals range between 1 and 10 million. We focus on finance that we don't do a lot of leasing, but we can do. We offer bespoke solutions that are focused primarily to our clients' needs. We're very much client and relationship focused here at First Source. Our geographic area has been Canada to Argentina, so all the way up and down north and south of the Americas. However, we just recently were approved with XM financing abilities, so we're just starting to get into some new markets.
Thank you, Chris. John.
Hi, Russ. Thanks very much for the introduction, and great to be on the panel with Andrew and Lee as well. In terms of Investec's aviation offering, it extends both across the fixed wing and the rotary aviation space, but helicopters is a key component of our strategy. In terms of our offering in the helicopter space, we look to provide debt financing solutions both to operators but also to lessors in the background. The transaction size we typically look at is anywhere between $5 million and $50 million, either as a single asset or as a portfolio of assets together. When it comes to looking at the asset specifically, we look at anything from a light single all the way up to a super medium helicopter, either new or pre-owned. We currently take a bit more of a conservative approach when looking at heavy helicopter transactions. I'd lean towards saying that we don't have appetite at the moment in the heavy space in the absence of significant mitigants. We generally manufacture and end-use agnostic, except for when it comes to military, which is scoped out of our risk parameters. But when we're looking at a helicopter type, generally, we consider factors such as the dynamics of supply, demand, and the recent liquidity dynamics. In terms of jurisdiction, being a bank listed in South Africa and in the United Kingdom, but having presence on all continents except for Antarctica, we're open to really looking anywhere across the globe and don't have a specific mandate in terms of jurisdiction. Over the last 18 months, we've had the opportunity to fund assets across North America, South America, Europe, Africa, and Asia. So really anywhere we can find a solution for the client.
Thank you, John. Within the kind of, if you consider helicopter leasing to be kind of a decade or so old at this point as an industry, you could consider we're in a relatively high interest rate environment currently. I'm interested to know, I'll go to Andy first, what do you think is going to happen to the interest rate environment in the near term, specifically, obviously with the US election results as they are, and also we've been seeing a sort of rise of private credit finance providers. I just interested to know whether you're butting up against that as a form of competition. Andy, I think he's frozen. Yeah, Chris, I'll get to you.
Okay, great. Yeah, I'm happy to answer that. We don't run into the private competition very much. We have seen a one or two here and there, but our interest rate forecast is looking like it's going to be trending slightly up. If you look at the Fed funds rate, it's about 4.58% right now, which is really close to the long-term average of 4.6. So if you extrapolate what's been going on politically with potential for new tariffs, it's possible that we would see further pressure on the Fed to continue lowering rates, but we haven't seen a direct correlation between the lowering of the Fed funds and what rates are available in the market.
Okay, thanks. John, have you got some thoughts on that?
Interesting question, Rush. I mean, it's hard to predict ultimately where the market is going and interest rates. From our side, it was a positive development that rates started coming down as inflation started to ease. The big question obviously is around what tariffs are going to do to that inflationary pressure. From a bank's perspective, everyone thinks the higher interest rates are better for us. Ultimately, on our side, I feel it's worse. There's less deals, it's more difficult, and becomes harder to get often the leasing transactions done as well, where there's already perhaps a capped lease rate coming into the transaction. So from our side, certainly we would welcome lower rates going forward, but it's going to be interesting to see how it plays out.
Yeah, of course, the pricing power of the lessors, whether it's present or not, and their ability to negotiate suitable lease rate for suitable coverage is a big impact there. But Andy, did you catch the question?
I caught the question and I gave you 30 seconds of the exact interest rate profile over the next 5 years when the connection left. So I can't repeat it, unfortunately. I was going to say that I think it's interesting that we've moved from the transition from where the world was very used to low rates, and we're now in a more stable, higher rate environment, albeit not high if we go back for more than 10 years. So they're actually pretty average over the long term. I think as long as the lease rates that lessors get, or if we're lending, the interest rate margins that the clients and lessors can put into their models to make sure that it still works, then I think we're okay. And I think the last 2 or 3 years has probably been the catch-up moment for that. So the looking on our sort of corporate VIP private owner book, these people like having liquidity, they like having money in the bank, so they are very happy to pay a relatively higher interest rate because they've still got the war chest in their own bank to pounce on deals when it happens. I think if you're locked into a long-term contract, then clearly you need to be able to reflect what the real cost of your money is into that contract to make it work. But we're not seeing any real signs of stress, as that goes through the cycle. Yeah,
as you mentioned, it's a higher interest rate environment currently, but in in the total of the history of interest rates, it's not particularly high. It's just higher than it was, and it's the ability for the market to absorb that and to adjust expectations, and for that to trickle down through the lessors to the end users, and for everybody to be able to adjust. Thanks, that's really useful, you guys. I did want to touch on oil and gas. Ed covered it somewhat in the first session, but you know, the oil and gas demand is up currently compared to what it was a few years ago. And also, I know that, you know, there are lessors with quite a lot of oil and gas exposure. They're probably looking to average down on that exposure, and being able to sell off risk and raise debt against oil and gas assets is an important part of that. We're looking at oil and gas deals all the time, and we're looking for debt for those. I'd be just interested to know, each of you, what your appetite is for oil and gas, whether you've been doing oil and gas deals, whether you have more appetite. Do you price it differently? How do you view that sector? Chris?
Yeah, it's a good question. We were historically in that sector. There's been a little bit of nationalization of some of our LATAM business areas that we were in, and once the nationalization started, we kind of took a hard look at that segment of oil and gas internationally, and we stopped providing the leasing product. So we're pretty much out of the oil and gas leasing market right now.
Thanks. John?
From Investec side, we remain active in the offshore helicopter market, including oil and gas, as well as wind and search and rescue. It's often a question of ESG, and it's really topical at the moment. So you correctly identified that many other banks, financiers, and lessors have an aversion to oil and gas helicopter transactions due to their focus on really the environment aspect of it. And Investec, we have a slightly different view, perhaps, from some of the markets that we're located in and transact in. And while environment's one important consideration, we can't forget necessarily the social and governance aspects as well. We have the benefit of operating in communities where our transactions are key to development of growth, and energy is part of this and critical to many of these economies and the global economy broadly. So yes, there needs to be a commitment to environment, but also to a just energy transition, where there's partly a responsibility on the banks to continue doing these transactions and not necessarily turning off the taps completely. So yes, from our side, it is an industry we continue to transact in and continue to see developments and growth going forward as well.
Thanks. And Andy, you'd raised a point. We were speaking before. You'd raised a point about ESG and how that provides certain pressure on you in underwriting, and I'm interested to know how that's impacting your underwriting approach and even cost of capital, perhaps.
Sure. So our approach broadly is very similar to John's at Investec. We at Close recognise that you can't just flick a switch and everyone's gone electric. You know, so we are very much about financing the transition and helping the world get there, and also recognising that it will take quite a long time to transition into whatever the next propulsion systems or methodologies are that get us there. Currently, we do not have any policy restrictions or red lines regarding financing the offshore support sector. What I'm really focused on at the moment is working towards how we start meeting our Scope 3 emissions requirements up in 2030, which includes being able to accurately report all of the CO2e which our finance fleet is doing. And I think at the moment there's no industry-wide accepted approach of what that looks like. So I think everyone's starting to report some numbers, but we're perhaps not all reporting the same numbers and in the same way. So I think that's something which, as a community, either the banks or the wider industry that we support, I think need to put some focus on, because I think the more certainty and clarity you can get around those numbers, then the more supportable continuing to finance it is in the future.
Yeah, thank you. Just as a general note, I just jotted down here a general question for my own benefit as well as anyone else's on the subject of economic useful life of a helicopter, because there are helicopters in the fleet, global fleet, that are 70 plus years old and doing exactly the same job perfectly well. But obviously when it comes to you guys, you have policies around maximum age. But obviously maximum age isn't economic life. They're two different things. But I'd like to interested to know, Chris, what your policy is around that.
Yeah, we have a very open book as far as age. We don't have any set hard lines in the sand that we would have to dissuade a client, because we're really focused on our client and getting that relationship to be symbiotic. We want the success of our client to be paramount to everything. So if they're operating an aircraft or a helicopter that's older than industry standard of 20 years, that doesn't bother us. What really kind of excites us is to see the ability of the operator to successfully operate the helicopter. And if they've got a track record, then we have a lot more ability to acquiesce on the age. So it's really more about the client than it is about the collateral.
Thanks. John, do you have a different policy?
Yeah, it's interesting, Russ. We don't actually have a set policy in terms of, age of asset or our view on the economic life. We do have in-house technical experts both on the fixed wing space and the rotary wing space as well. We still generally make use of third-party appraisers to assist us on forecast values, but largely also the liquidity and the supply and demand dynamics around an asset. So that may be an asset that's 20, 30 years old. You've got to consider those supply and demand dynamics, but then similarly, a brand new asset type could have those same constraints as well. So it's really a process of engaging with those third-party appraisers and lessors and just understanding what they're seeing in the market specifically at that time.
Thanks. Andy, expanding on what John said, that the industry likes this term core and non-core asset types, liquidity is affected by these terms. Do you have a view on sort of no-go assets or life, economic useful life?
Not really. We are fairly age agnostic. I think the same as the rest of the panel. The key thing for me is availability of spares and the infrastructure and the approvals to keep the older aircraft flying, because it might have an economic useful life to do a certain job, which will be second or third use, from what it started at. But if you have to wait 9 months for a part, then it's not really worth anything. So we're more interested in, can it still fly? Is it supported in the in the wide world? Can it do the mission that it was designed to do because of the infrastructure that's around it? And ultimately, we could look at part outs in terms of an exit if we became the owner of an aircraft via a distress. So we can look at that as well. But it's more about, can it keep flying for the term of the loan, as opposed to how old is it as a red line.
That's really interesting to know, actually, that banks will take that pragmatic view and look at things on an individual basis like that, rather than have a set policy. That's encouraging. That kind of comes to the end of the sort of key questions I'd thought of. I don't know if anyone has anything specific they want to say before we wrap things up about what they've been working on, or no, you're all good. Okay, well, in that case, I'll hand back to Al to wrap things up. Thanks very much, guys, for joining.
Thanks, Russell.
Or Emmanuel, in this case.
Thank you very much to Russell, Christopher, Ed Sale, and Ed Washeka for animating today's panel. Huge thank you to Al White for moderating this Finance and Leasing Roundtable. We look forward to see you, Al, and the entire Heli Investor team in Sao Paulo, April 15, 16, and London, June 4 and 5, 2025. Next Heli Market Trends Live will be January 23rd, 2025, focused on MRO and supply chain. Thank you very much for attending. See you all next time.